we're at a point where equities are at all-time highs. The job market is okay, depending on which revision we're looking at these days, apparently. And all of a sudden, the Fed is cutting rates and doing QE again. So the old days of, like the Warren Buffett, like Benjamin Graham, fundamental value investing, I'm sorry, everyone, that does not exist anymore because we're in this constant state where we need stimulus to keep things going.
This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is Keith Dicker, founder and CIO of IceCap Asset Management, and also the host of the Loonie Hour, which, for those that don't know, i.e. the rest of our audience that is not Canadian, because I am Canadian, as you know, and we have another Canadian on the show today. The Loonie Hour is awesome if you want to keep up to date on the macro world specific to Canada. So I'm a regular listener. But Keith, great to have you on the show. What's going on?
Hey, Felix, thanks for having me today. It's always exciting. The world is so interesting today. It's so easy to have a conversation about it. And then you have another Canadian on, with that conversation at the same time. And I think you'll agree, a lot of Canadians think the world revolves around Canada. And then as you become a bit more knowledgeable about the world, you realize that's not the case at all. So, we'll have a great conversation today. There's so many things going on that will impact Canada, but that's also going to, though, impact, all other markets and economies and regions around the world. Like we are really set up for a great year coming up next year.
Yeah, I couldn't agree more. So we'll cover our bases. I'm out here on the West Coast, on the Pacific. You're out there on the Atlantic, and we'll meet in the middle and figure out how the world is moving in different directions and how that impacts Canada. But yeah, I think you, as a fellow Canadian, you view global macro quite similar to me, I think, which is that we just all have to pay attention to the US and see what's going there. And it really drives so much of how to think about things. So even though we will get into what's going on in the Canadian world in a minute, I do want to start with what's going on in the US. And we've been in an interesting few months. We've had this government shutdown, so we've been missing a lot of pretty important economic data. It's starting to slowly trickle in now. Right before that shutdown happened, you had this labor market scare situation where it was looking pretty shaky, on shaky ground. And then you also had inflation that was above target. And then you have this question of, are tariffs going to increase inflation or not, or how to think about that? So a lot of moving parts. Just want to get your read on how you're thinking about U.S. macro as it stands right now.
Yeah, I think, I think the whole tariff story, obviously in Canada, it's seemingly a lot more important in Canada than it is for the Americans. And that's fine because it is what it is. You can't change how people view things or think about things. But the real big story that we look at right now with markets, so I like to say, as investment managers, we need to be insensitive about things. We can't have feelings about stuff. And, sometimes we can get in trouble sometimes with the media because, we're not saying the right things, so to speak. Not on Forward Guidance, though. We can say whatever we want here, right?
True. Yes.
Yeah, no one's going to do it. But I think, though, one of the most important, I guess, concepts for people in the investment world to appreciate. First of all, you absolutely have to understand how the U.S. banking and monetary system is put together. And because it is really the epicenter for the world. It's what attracts capital flows coming in or can encourage capital flows to leave. And I think people know the dollar, it is the reserve currency. And by the way, that just doesn't mean that people agreed in a room. Yeah, we'll call it the reserve currency. All global trade, most global trade, it is flowing through dollars all the time. And to be sort of very generic with this comment, about half of dollars created around the world are created domestically in the US, and the other half is outside, which is really the euro dollar market. But with that, why don't we start the conversation with, again, what we're looking at all the time here is that really since the American housing market crashed in 08, 09. We then had over a decade with zero rates, negative rates, or near zero rates, and QE, and the Europeans went through like so many different programs to try to hide a bad loan on their books, and it's still dangling out there. But the reason I bring this up is because we had over a decade where the global yield curve was suppressed, or put another way, risk wasn't being properly priced in the investment world. And because every single market in the world, whether it's financial markets or asset markets, they're all influenced directly or indirectly by the yield curve. And because we didn't have a true price discovery taking place in the bond market, it therefore distorted a lot of different markets around the world. But what's actually happened over time, so since, call it now we're in the year 15, the global financial system is now in this constant state that it needs stimulus to survive, to breathe. And the moment the stimulus just begins to sort of tighten somewhat, then it breaks down. So it's actually good timing, Felix, because back in so you might remember in December 2018.
Oh yeah,
yeah. So do you remember the Repo story? What happened back then?
Yeah, for sure. Yeah.
Why don't you share with everyone like a quick 30 seconds on that story?
Yeah, totally. So for the first time in a long time, Powell was hiking rates, and at the same time, we were doing QT 1.0, and at that time, reserve levels were starting to get pretty low, and they didn't have the standard repo facility that exists today. So what happened is that the monetary plumbing, the most important parts of that plumbing network started to break, and you started to see, the Fed funds start to trade above the upper range, so above where they wanted to actually have monetary policy. And so overnight, we saw them completely. We saw the Powell pivot is basically what it started to be called. Like I think it was like Christmas Eve of December 2018. And we saw this complete reversal pretty much within that week, which is that, okay, we're done hiking rates, we're ending QT. And then pretty quick, in quick order, we did see that these repo tantrums. So then we started to see them also begin to expand the balance sheet. And I think where you're getting at, Keith, is that a lot of the things I just said seem to be happening right now. Is that where you're going with that?
Yeah, absolutely. So I remember, I'm in Halifax, by the way. I'm based in Nova Scotia for the American viewers. We all have Christmas traditions, and, for in our sort of group of friends, all the lads, we all go to the pub on Christmas Eve, and we all have some drinks and some food and everything. And I'm down there on Christmas Eve, and markets are just tanking. Like, I think equities were down maybe almost 20%, Felix, from the high to the low in December. And all my other friends, they're not in my world, they're
just enjoying their drinks.
I'm in the capital of socialism in Canada, where I am. That's where I am. But I'm sitting there going, oh boy, this Guinness was hard to swallow, by the minute. But the main point was that, after having almost a decade with the Americans, of course, they're just constantly putting stimulus into the system, whether it's with lower rates all the time or, QE. And then you got the fiscal stimulus happening at the same time. And then they started to, remember they were raising rates, 25 basis points every two meetings. Like it was the most, best monetary visibility you could ever have. And of course, it got to a point where it just completely choked off the rest of the world. But it also reduced the amount of bank reserves at the Fed down to a level that we're discovering now. It was not tolerable. There wasn't enough bank reserves at the Fed that could then really feed the U.S. economy. So I think these days, they will measure reserves of the bank as percentage of GDP. And I think I got down to about 7.5%, 8% at that time. And that's when you had the repo market, went from 2% to 10% overnight. And was that because people were afraid to lend to each other, or there wasn't sufficient collateral in the system? It sort of goes both ways. Do you know what I mean? And of course, that's when the Fed had to completely reverse course and go in. And then, the COVID challenge, experience, whatever you want to call that, came around. And that just gave central banks everywhere the green light to once again, let's flood the system. So the reason I bring that up is because I prefaced it by saying, we're in this constant need of stimulus coming into financial markets. And now all of a sudden we're sort of starting to experience this new cycle with long-term rates. Then all of a sudden now rates have gone higher. We'll come back to the whole inflation overnight rate story as well. But, I think people understand that long-term rates, they're probably around 5% in the 60s. They hit 15 or 20% in the early 80s, depending on where you were. But from the 80s, 90s, O's, and then you had that lost decade. And then a couple of years after into 2022, we've had over 40 years where rates were always going lower. And then the last 10 years of that was with all the stimulus coming into the system. And, central bankers being, very good academics, of course, they realize we need to reduce our involvement with the balance sheet. Let's get capitalism back, and all that stuff going on. And then the moment to try to do it, it just doesn't work. And so this is the point where we're at today. So ironically, here we are D9, so December the 9th, of course. And we're a couple of weeks away for Christmas. At the exact same time, with the Fed meeting tomorrow. And, they're cutting, of course. That's what the market is pricing in. But they're also probably going to sneak in, hey, where QE is back on the table. That's where we are again. And it's because bank reserves, they've now come down to the point where the Fed is, for the first time ever, they're trying to be proactive in trying to avoid another one of these sort of repo accidents. Because when we get one of those accidents again, it's because the economy is bigger, financial system is bigger than it was back in 2018. The probability of a bank or maybe, a large fund structure of some sort going offside, which then has contagion effects, we're getting back to that moment again. So I think now the bank reserves at the Fed is around 10% of the U.S. economy. So there's no hard number that, hey, they hit the switch. But the guys at the Fed, they definitely see this. I mean, we're talking about it, of course, and they are aware of it, and they're going to start expanding the system again. Of course, that gives so once you start pushing more stimulus into the economy again, obviously it gives, hey, it's it go all in on risk again. So we have the opportunity here for risk markets to just blast off again. But it's also going to create an opportunity for inflation just to surge again as well. So think about it. We're at a point where equities are at all-time highs. The job market is okay, depending on which revision we're looking at these days, apparently. And all of a sudden, the Fed is cutting rates and doing QE again. So the old days of like the Warren Buffett, like Benjamin Graham, fundamental value investing. I'm sorry, everyone, that does not exist anymore because we're in this constant state where we need stimulus to keep things going. And that's what's happening.
If you're thinking about crypto investing but don't want to open a new account or manage keys and wallets, check out Grayscale. Grayscale has been offering trusted crypto investment products for over a decade, with 30 and plus counting, including single asset funds like Bitcoin and Ethereum, diversified portfolios, and thematic exposure to the broader digital asset space. Many of their products are available directly through your brokerage or IRA, just like a stock or ETF. Investing involves risks, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. Yeah, I can agree more. I mean, like what we were saying off camera before we hit record, I was trying to attempt to be a value investor back in the day and quickly realized that you're right. Instead, we need to be just tracking where the liquidity impulse is coming from, where the stimulus going, and just knowing when to jump on that train. I do agree that this Fed meeting, there's a pretty high probability that they're going to basically lay out the groundwork for balance sheet expansion coming up real soon. Like it's clear where we're at right now with reserve levels is not enough. And like I said, there is this standard repo facility thing that they do have available, but it's just not seeing the pickup that they want to see. So it's clear, yes, they need to start increasing bank reserves by buying treasuries. And I guess that one question, just to go a little bit more granular here around this idea of QE, is I see that as taking a lot of different forms, right? Like there was QE infinity basically in 2021 where they're just throwing hundreds of billions of dollars every month and they're buying long duration debt. And then there's also, you know, what we saw in 2019, which is where they're just buying low duration, like short duration bills. And so I'm curious, how do you think about the spectrum of the forces? Is it just, okay, they're expanding balance sheet long risk, or is it like, okay, well, they're likely going to be focused on short duration, and you know, if you're just swapping a bill for a reserve, does that really, you know, move the mark, or do they really need to be buying those long bonds to really see the impulse on liquidity? How do you think about all that?
I'm not putting as much thought into it as what people might want to hear. So to sort of take that for what it is. You know, they are just not randomly deciding, let's put it on this part of the curve or that. They're doing it to ensure there is enough liquidity within the banking system to make things work. I mean, that's the number one goal. The real interesting movement that's taking place now, of course, you know, because deficits are enormous around the world.
Yeah.
You know, here in Canada, of course, you know, again, non-Canadians are not aware of the story, but you know, you can't have a big enough deficit, apparently. And everyone's going to love it no matter what. But the same thing is happening, you know, with the Brits and the French and everyone else. But the real interesting story that we see now with the Americans is, you know, the introduction, you know, they're introducing stable coins. They're going to get accepted and improved. And the reason the government is saying, yeah, we're all in on this, because they're saying stable coins will need a reserve, and that reserve has to be treasuries, U.S. treasuries. So, you know, you can have the Fed doing QE. They're going to try to position that into the market in a way to create stimulus, of course. But all of a sudden, you know, with the introduction of this whole new market now to buy American debt from deficits, it just gives the Americans this whole new list of opportunities and possibilities, which is unlike any other country in the world. And that's why you just can't look at the US, you know, all the twin deficits and all that stuff, and compare it to Canada, for example, or somewhere else. It's very different. So, you know, we do suspect or expect that the world is transitioning to a new financial experience, if you want to use that word. It's happening. We can't stop it. It doesn't mean that the world has to, you know, go crash or kaboom overnight, but that there is this transition that's taking place, and there's always a battle around the world for foreign investment and capital. And I think the Americans are set up right now very well to attract a lot more foreign capital coming in. So if foreign capital is coming into one country, it means it's leaving somewhere else. And this is incredibly bullish, you know, for the Americans to be able to prolong their experience we're having, but also for the Fed to say, yeah, we're just going to keep pumping stimulus in. Because, well, yeah, because the economy can only grow if it has credit coming in.
Yeah.
And if, you know, the JP Morgans of the world, if they're restricted for what they could push out into the economy because the reserves are only at a certain level, then it doesn't work. You know, the system breaks by itself. So it is sort of, you know, these new policies that are being taken place and enforced by the Americans, it has to be met at the same time with the same tune and direction as what the Fed is going to do. Otherwise, it just doesn't work. And you know, that's where we're headed.
Yeah, I totally agree. I want to throw a thesis at you that I've been thinking about and see your take on it, and I think it'll lead into a few different interesting discussion points. But when I look at the last few years, to your point about how we're just about to go into this monetary expansion regime, but for the past few years, we've had the fastest hiking regime. We've had QT, even though it's been partially offset by what's been going on with like reverse repo and that sort of thing, but still it's been going on. So the direction is towards that. We've seen loan growth and the credit markets be pretty stagnant, but and so that led to a lot of folks believing that we were going to have a recession in 2022. Like we were at one point there where economists, it was like 100% were on board with this idea of recession. And, you know, depending on how you piece it apart, you could say that we didn't get it. And that maybe one of the big reasons is because we had such a huge fiscal impulse, like we ran such wide deficits, and people were not used to a regime where we had to pay attention to fiscal as much. Like we just came from the doldrums of the 2010s where, you know, we had the Tea Party movement and that sort of thing. Like nobody wanted to spend money. And then suddenly it's just like guns blazing and people are offside. So now when I look at the next year or so, I think you're right that monetary expansion is about to just, you know, we're just going to put the pedal to the metal here. But then I also look at what's going on the fiscal side, and it seems like despite what they were trying to do with Doge and that sort of thing, we're still moving forward with high deficits. So yeah, do you feel like we sort of skipped through this recession over the last couple of years, and now we're just going to gas it on the monetary and fiscal side?
I think I know, or in the probability world, the probability of recessions are a lot higher outside of the U.S. than within the U.S. So, I mean, if you're looking at Canada or Europe, for example, the probability of those economies experiencing and then with some metrics you look at in Canada, especially, we're already in a recession. It's already happening. But if it's happening there and the U.S. continues to be somewhat stable, it's going to suck more capital out of Canada, or any European investment that was thinking about Canada, it would go to the U.S. instead. So the strength of the U.S. right now is really the weakness of other markets. So again, you can get a sense, everyone in the audience here, don't just look at one market on its own. Look at everything, the whole world combined, and sort of picture the globe with, current flows, you see the oceans and stuff like that. But that's where we see that it's not really the US where we see the risk right now. It's clearly elsewhere. And then that's what could trigger, one of these, off-market experiences coming up. I think Europe looks incredibly vulnerable. And we can talk about that. But in Canada, our market, if we do get a stronger recession than what we currently have. Of course, I think everyone knows what the definition of a recession is. If your neighbor loses their job, that's bad luck. If you lose your job, then it's a recession. So it depends on where you are. But right now, for the first time in, a couple of decades, the challenges in Canada right now, it's in Ontario. That's where it is. Before that, the only recessions Canada really experienced was from the oil patch, with the cyclicality with commodity prices, of course. And, we've been told in Canada, don't worry about Alberta. You're not allowed to worry about them at all. But now the opposite is taking place. So in Canada, the risk is that we do go into recession, and it's happening. A lot of small businesses are struggling. Larger companies are announcing layoffs and downsizing and stuff like that. It doesn't matter if it's tariff-related or not. The flow has already started. So in Canada, if we do get a tighter labor market, it's going to do a couple of things. But first of all, it's really going to affect the loan portfolios of the banks. So the probability of this, I like to say, will rip the soul out of Bay Street. And Bay Street hasn't experienced a big recession since really the early 90s in Canada. And then you look at what's happening over the UK, and as well as with France, and especially Germany. They're being gutted out. Again, the probability of those economies experiencing something bad will actually be very positive for the Americans, because then more money will come in. So it could actually help the Americans slow any slowdown they might have and just keep things going, especially with the stimulus that's coming. Now, of course, that doesn't mean that the equity markets can't get tripped up. I mean, we could clearly use, a bit of a cleansing, of this enthusiasm that's put into equity markets. But, but then that should just set the stage then, for a blast off coming up.
It's interesting to hear you talk about this fragility in the Canadian economy, because if you look at the news headlines this last week, or especially the Canadian bond market, like we had a stellar GDP print, we had a stellar jobs print at least on the top line level. But I know you've been looking at this, but if you look at, say, the growth outlook, the reason it rebounded so much was mostly just a net exports function, and actually like consumption was negative. And then the same time with the jobs report, you had this stellar rebound in jobs, but it was all part-time jobs, and full-time jobs were negative. So I'm just curious, like you're an asset manager, as you try to think about this, like it is quite clear where the direction is going, but man, the path to get there is hard. Like those prints, even though when you look a little bit deeper, they look weak. Canadian bonds sold off like crazy. We saw a huge strengthening of the Canadian dollar. So I'm just curious, like, how do you manage that path dependency? Because it's not easy, even if you can say what you're saying, and I can agree with you. It's like, we still have to get there to the other side of this trade.
Yeah, what's really interesting with my profession, we're professional money managers. That's what we do, and I like to say, with the industry, whenever there's strong returns within the industry, then the industry will always attribute that to a skill set. Great at stock picking, or this manager has an offices in 5 countries and 3 languages. That kind of stuff. And then the moment there's failure, and there's always failure in the investment world, it happens all the time. The industry will always say, "Hey, that's bad luck. No one saw it coming. Hang in there for the long run, pal," and stuff like that. So this year has been a good year. If you've been very aggressive and very singularly focused in different parts of the market, a lot of people had a very good year. Most professional managers, we rarely go all in on a market or all out, because we live in a probability world. And so for us, with sort of this experience that could come up, so we're in equities, of course. We're not all in, we're not all out either. We would really, we would not be disappointed at all if equities corrected right now. We would say, "Hey, this is a gift. This is actually moving the way it should move," and then we'll get aggressive with it. So when you measure all, or you assess and view all of these risks that are happening around the world, you sort of have to figure out, okay, which one is significant. There's always something lying around, but if you get a big bang in one of them, how is that then going to affect the marketplace? And again, in our view right now, it's clearly in the credit and liquidity world. One sort of leads to the other, and then of course we have the whole geopolitical risk. It seems to be accelerating right now, between the NATO, proxy war with Russia and so forth. So everything is setting up. Hopefully we have a nice Christmas coming up, and then we set up then into January. That will really show people what's happening.
The second big question I have for you on the Canadian side of things is, I mean, you kind of referenced it earlier around this, forget about Alberta. Don't talk about Alberta. Don't talk about oil. We're just going to, speculate on real estate forever, and that'll be our economy instead. And we are starting to see some shifts in terms of that narrative. And of course, Mark Carney is the Liberal Party, so he is the continuation of the Trudeau government, but we are still seeing some granular shifts towards being more positive towards natural resources and oil and being friendly to Alberta. And it really climaxed into this MOU that was laid out with the Alberta Premier, basically with the guise of unlocking oil production again and really getting that gear spinning again from Alberta. So I'm just curious, how do you high level think about that framework of the shift? How do you figure out, what's genuine or not? And how does that get incorporated into asset allocation as a portfolio manager?
Yeah, so you always try to have a look at these changes or risk for any country from the perspective of an international or foreign investor. So right now with this memorandum of understanding between Ottawa and Alberta, basically, is so if I'm a foreign investor, I'll look at this and I'll say, "Hey, is this positive for Canada or is it negative?" And clearly, on the face of it, it is 100% positive. So Canada, again, for a non-Canadian audience, and even for maybe a lot of the Canadian audience who aren't aware of it, Canada, we really only export one thing. Our net exports, it's all energy. That's what it is. Our net exports, by the way, that's what it is. And if we didn't do that, we would have no US dollars coming into our economy and banking system, and we would really struggle in that environment. So the way that we would want to grow as an economy, it can't be housing. That's what, again, that go back to that lost decade. Rates weren't allowed to go higher and deficits didn't matter. It just pumped housing up to high levels. That was also driven by population growth as well, by the way. But to be a successful economy, we need to attract foreign investment coming in. And that's not going to come in for the housing market. It's going to come in for the energy sector. So on the face of it, yeah, Felix, this is 100% positive. I would argue don't really know all the details yet, because a memorandum of understanding is, we'll agree, we'll hang out, we'll date a few times and maybe make out, of course, and we'll do that. But then we got to get into the details and how is it going to work and appreciate. But this was a definite positive movement. I mean, Canadian dollar strengthened, I think, 0.5 point on the day. It was a good one. And of course, then we had that, employment report that you referenced and the GDP report as well. So there's been some really good headline information or news coming out of Canada over the last couple of weeks.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. As always, investments and blockchain technology involve risk, terms, and conditions apply. Do your own research. Okay, so for the last part of the conversation, just want to get a little bit more into asset allocation, how you think about different asset classes in light of everything we talked about. So we have the monetary expansion regime for the US is about to get going in earnest. We have still positive tailwinds in terms of the fiscal deficit side of things. The risk is the rest of the other countries, especially Europe, you mentioned, being quite vulnerable and fragile. So I'm just curious, starting, you could talk a bit about equities, but also fixed income. I know you focus a lot on that. And I'm just curious, how do you think about the composition of asset classes within this regime for the next year or so?
So I think the first thing that people need to appreciate, earlier I referenced the 10-year yield and how it's moved. So again, maybe you can pull that chart up that I think that we have here to show everyone.
Yeah.
Again, we had a 30 to 40-year cycle where rates were never going higher. The 10-year rate was never going higher; it was always going lower, and that created, really the balanced fund mandate for people to think about that. So you're getting a combination of equities, plus fixed income, and people know when you invest in the stock market, you are implicitly agreeing to an experience where you can be up 50% in a year or down 50%. If you're up 50%, it's a skill set, Felix. You're good at stock picking, that you mentioned earlier. If we're down 50%, then you don't like it, but you respect it because it is the stock market. But the bond market was always there to bail you out. But that was only because we had the duration effect. With long-term rates going lower, you always made money in the bond market. So when rates hit 0%, basically in 08, 09, and then all central banks got together to prevent overnight rates from going higher, basically, and then QE to try to flatten the curve, it really sort of delayed or stalled the bond market from going to where it should have went. And so that created then this the sort of movement in the bond world where you weren't generating enough yield focusing on sovereign government debt in your bond funds. So they had to increasingly take on more and more risk. So you move from government bonds, investment grade, then high yield and junk bonds. Yeah, here we go. Here is a good one. Then you're adding emerging market or hybrid securities, and you're doing that to increase yield. And it's so that, a lot of retail investors and even private clients, all of a sudden that they're still, earning 5, 6, 7% yield from their bond investment, which keeps that whole bond balance fund strategy intact. This doesn't exist anymore. So now we're back to this period where long rates are going higher again. Overnight rates have gone higher. There are a lot of economies where they're sort of grinding tighter and tighter. At the same time, all governments are running bigger deficits than they did the year before or what they targeted at the beginning of the year. And again, just to give people an example of why it's important, in Canada right now, Canada spends, at Ottawa, we spend about $55 billion of our tax revenue just on interest on federal debt. Now, the Americans say, well, we talk in trillions these days. It's not a big deal.
Exactly.
Okay. But to give you an example though, that $55 billion, that's the same amount that the federal government in Canada, that's what they give back to provinces for healthcare spending. So it's a big amount. This coming year, the amount of tax revenue that we use to pay interest on debt coming up is going to go over $60 billion. So again, it becomes an unproductive use of our tax revenue. So now all of a sudden, the tax revenue that's coming in, less of it is being used for productive investment. Meanwhile, because we always have deficits now and they're bigger, it means that the debt burden is getting larger and larger. And the same thing is happening with in Britain and France and you name it. So it's our view that, this goes back to the asset allocation question, of course. And so what I'm sharing with investors here on people who are in the audience is that the challenge or the risk we have today in financial markets is not the stock market. It's always going to do its thing. It is the bond market. So the potential for a very significant country experiencing a liquidity crisis is very high. So the Brits had it twice in about 4 years. So nothing happens in twos, what they say, there is threes. But when that happens, the probability of that creating contagion to other markets in our mind is quite high. And that's not a bad thing because we know exactly what will happen next. So if it does happen, central banks will absolutely do QE to bail out the government bond market. And they have to do that because if they don't do that, commercial banks just fall over. Because the regulatory capital is mandated to be in sovereign debt. It has to be there. But then that just means then that risk will then get expressed in credit markets or non-government debt. And, because of the chart that we just showed in the diagram, showed the evolution of risk-taking in the bond market world, the probability of a lot of investors who are low risk and conservative, they're in a position to potentially experience significant or severe losses with their investments. And it's unknown to them because they've been told, hey, the bond market is always low risk and conservative. 40 years is a long time. No one's alive today managing money who was around in the 60s. Right? That stuff doesn't exist. However, we are set up perfectly for that moment again. So for us, our only exposure to the bond market is in short-term government debt. We know that is solid. We'll get bailed out on that if something severe happens. Nothing in the credit world. But if one of these events does happen, it's likely going to drive even more foreign investment, money that's mobile, capital is mobile, into the U.S. Treasury market for safety and security, which then further drives the U.S. dollar higher. So for us, we have a significant allocation to currency markets that will benefit from a strengthening U.S. dollar with everything else going lower. And, the thing I'll leave everyone with here, do you know how you make 5 times your money in the bond market?
How?
You buy the bonds for 20 cents on the dollar. So I don't know if we're coming up to that moment, but maybe 60 cents. We are potentially, and again, it's because we've become accustomed to seeing every sort of financial accident is always the stock market's fault. That's totally what it is. And it's our view today, that's not the case at all. The initial reaction will be down for equities. But then once markets realize, oh, wow, hey, it's not the stock market's not the problem here. It's the bond market. That's where it is. And then you get that adjustment taking place. So I think we could have this just most sensational financial monetary experience coming up, and there's going to be a lot of chaos and confusion with it as it's happening. But managers who can understand it and appreciate, who are positioned for it coming up, I think the opportunities are not only to protect your money, but even make money on the upside. Because again, I think it's very clear where it's going. Because every day we get to say more information just to confirm it.
Yeah, 100%. Oftentimes when I hear about this perspective that long duration fixed income is pretty much uninvestable right now, a lot of folks will end up saying, okay, well then obviously you can see the clear runway for equities. That makes sense. But then what else do I add to my portfolio? And then pretty quickly the answer comes up of precious metals, i.e. gold or commodities and the like. So I'm curious, what's your perspective on that side of things? Do you see that as being something that better diversify in light of the fact that fixed income is just a mess right now for a portfolio?
Yeah, so we have significant allocations to those markets. So gold bullion is separate from regular commodities. We hold gold bullion. It's been a great year for gold. Of course, everyone knows that. We also have significant allocations to crude oil and especially food agriculture, the corn, soy, wheat, cattle, coffee, all that stuff that we're consuming all the time. So in our view, the balanced fund structure today is different than what the industry is used. So the industry, call it 60-40 as an example, or some derivative of that. The new version of a balanced fund to protect investors all the time. Now you're really going to have, cash is an asset class to use. You have cash, you have gold, you have currencies. You do separate fixed income between government and credit, equities there, commodities, and then non-directional strategies as well. If you're really pushing all those together with true asset classes that do have a low correlation to each other, even during times of stress, that's where you'll get opportunities coming up. But the simple answer to your commodity question, we wouldn't be surprised at all if next year oil is this year's gold, if that makes sense. Gold had a great year this year. We're positioned to benefit if next year it's oil's turn to have that runway coming up, and it could do that easily if we get global conflict taking place. Inflation, the cost of just shipping everything around the world continues to go higher. Gold can, be a real nice addition to anyone's. That's the gold. I meant to say oil. Oil can be a real nice addition to everyone's portfolio. That's the commodity, by the way, not necessarily the equities.
And then the last part of portfolio composition is, you mentioned a couple times about how there's just this tail risk of the Fed will come in and save the day. But there is always that interim moment where correlations go to one, margin calls happen, things just get sold regardless of what they are. And so I'm curious, how do you think about managing those sort of tail risks? Like, do you go out and have some sort of long volatility hedge? Do you buy long dated out of the money puts just as like a tail risk hedge? Or is that just, obviously that's going to cost a lot of carry to carry those on your portfolios? It's just a waste of time, and just going to try to make sure that during those correlation to one moments I don't get carried out, and then know that I can just double down when the central bank comes to save the day.
Yeah, I mean, for us specifically, we're not doing that. It's just because of the market. So we manage money for families and individuals mostly. So they're all separately managed portfolios. It just don't have the structure in place to do that. And I think a lot of people know tail risk funds, when they're right and they pay off, it's fantastic. It happens. And then you're even more right. The cost of carrying that all the time, it can really eat away. So for us, we're focused more on the natural, diversification across these different markets, and we'll adjust them as we go on. Again, like gold has been a great example. All of a sudden, people have been holding gold, for 40 years, saying, "Hey, I knew I was right," and yeah, you're right now today, of course. Again, we hold it. Like, we're not anti-gold or pro-gold. We fully appreciate what it is. But the opportunity coming up to see some real significant volatility. You can tell I'm smiling, hey? It's that insensitive, it's that insensitive money manager part coming in here. Yeah, and the risk is going to come out where people are not expecting it. Yeah. And, again, with the Fed meeting this week, if they don't come out with some soft form of QE, meat's back on the table, everyone. If they don't do that, then I think they're going to be behind the ball. We could see that sort of repo crisis again.
Yeah, I agree with that for sure. Keith, always great to have you on here and chat with a fellow Canadian. That was wildly overdue. I know Jack had you on a couple of years ago, but great to get it done and chat with you again. I'm a big fan of the Loonie Hour podcast that you guys are doing. It's great stuff. And where else can folks go if they want to hear more about IceCap specifically?
Yeah, so to follow us, IceCap Asset Management Course.com, at IceCap Global, on X. We're Canadian focused, global macro, and there's not a lot of firms like us in Canada, because Canada, it is dominated by the big banks and a couple of big insurance companies. But there's a lot of, real interesting, smaller boutique firms out here. And again, it's just an interesting market for us because it's kind of easier to stand out against the banks because, they can't talk like this. Yeah. So we're having a lot of success, as a manager.
You're not going to hear them hating on the 60-40 portfolio as much.
Oh God, no! They would never do that. You know,
Yeah.
they can't do it. So, but Felix, I love these conversations, and let's definitely do it again at some point in the new year.
Awesome.